So what's going on with gold is that number one, the dollar has just been soaring, right? The dollar's up again. And what's interesting is that gold had been going up with the dollar for quite some time because people were so nervous about the election. Was there going to be violence? Was there going to be this? Well, none of that happened. And the dollar is still staying strong. So now you're seeing kind of the bubble is being slightly deflated. Now, I'm still a huge bull on gold long term, and I still think we're going north of 3,000. But if you look at this chart, very clearly you have these lows here, and then this high matched perfectly with this high pivot. In fact, that's where I was shorting gold. So I still have long term holds on gold where I'm like, okay, this is my long term portfolio. I still believe it's going to 3,000. It doesn't mean I don't swing trade short.
According to leading market experts, gold is still expected to climb significantly higher in the coming years, despite a recent short-term pullback. Gareth Soloway, a prominent market strategist and technical analysis expert, remains bullish on the precious metal, forecasting that gold will surpass the $3,000. Soloway noted a key chart pattern showing matching highs, which prompted him to take a short position on gold. However, he maintains long-term bullish positions and swings trades to capitalize on short-term price movements. Gold market bulls are eyeing a potential surge to $3,000 per ounce, fueled by monetary easing from major central banks and a tight U.S. presidential election race. Despite a recent drop in gold prices, with spot gold falling over 2.5% to $2,617.96 per ounce due to the strong U.S. dollar, the metal is on track for its best annual performance since 2020. A rise of over 24% is driven by safe haven demand amid geopolitical and economic uncertainty and robust central bank buying. In addition to gold, Soloway finds palladium attractive as it begins to recover, and he also sees buying opportunities in silver. He points out that silver recently broke down and expects a buying opportunity in the $28 to $29 range based on a bullish consolidation pattern. Silver prices have fallen, with the current price at $30.24 per troy ounce, according to FX Street data. This marks a 1.49% drop from the previous price of $30.70. The silver market is experiencing a dynamic period driven by rising demand across various industries. With demand outpacing supply for the fourth consecutive year, silver is becoming an attractive investment opportunity, offering both strategic diversification and potential for capital appreciation. Before we dive into this video, please remember to subscribe to our channel, hit the bell icon, and share.
So what's going on with gold is that number one, the dollar has just been soaring, right? The dollar's up again. And what's interesting is that gold had been going up with the dollar for quite some time because people were so nervous about the election. Was there going to be violence? Was there going to be this? Well, none of that happened. And the dollar is still staying strong. So now you're seeing kind of the bubble is being slightly deflated. Now, I'm still a huge bull on gold long term, and I still think we're going north of 3,000. But if you look at this chart, very clearly you have these lows here, and then this high matched perfectly with this high pivot. In fact, that's where I was shorting gold. So I still have long-term holds on gold where I'm like, okay, this is my long-term portfolio. I still believe it's going to 3,000. It doesn't mean I don't swing trade short when I see an opportunity like this. And again, my guess is we're coming down to about the 2,500 level, which would be the low end here. And you have to flush out all the weak hands. The markets are amazing. They want to test the buyers, the will of the buyers, and they want to test the shorters, right? So they'll push it up ridiculously where the shorts get crushed. And then they want to flush out all those weak hands that bought at the highs here by bringing it back in. And that's for all risk asset. Well, not even risk assets. Gold isn't even a risk asset, but that's for all assets. And so I think we pull back here. You got to flush out the weak hands. And then I think it stabilizes once we see the new administration and maybe that there's no curb in spending. The dollar may start to weaken at that point, especially if the economy begins to weaken as well. And then I think gold resumes its bull move towards 3,000. My feeling is that we are not out of the woods, that ultimately it won't be as soft of or no landing as the Fed believes. I believe that there will be tariffs, and that's going to create potentially inflation. And so I think that those things, as a protector of my own capital, make gold a safer play. It doesn't mean it's going to be the best performer, and I want to be clear on that. But at least in terms of risk reward, which is my job as a guider of my own assets and my family's assets, that's where I will have most of my money, and I'll be buying on a pullback. If it gets to 2,500, if it gets below that, I will continue to slowly accumulate. And by the way, palladium looks interesting. It's coming back finally. I mean, there are other assets, and even silver. I know people love their silver. I'll show you a quick chart on silver here for people to see where the level is that we've just broken down here. And I think this $29 to $28 level right in here is where it's going to be a buying opportunity on silver. That'll be kind of right back. You had this move up, bullish consolidation, breakout, and then retrace right in here to 28 to 29. And I think silver becomes a buy there as well. I would stick with, so for 2025, I would stick with gold if it gets back to 2,500. I think it's still going to come there. So I'm not running out to buy gold here at these levels just yet. And then also the bonds. Bonds, I think with yields staying a little bit higher, I think I'd be somewhat surprised if we don't have a sharp pullback like you mentioned with the Reagan taking into the presidency there and on these type of situations. So I'm expecting at least early in the year some sort of big pullback in the markets, and that should coincide with a Bitcoin pullback as well. And maybe gold at that point starts to get its mojo back and head towards 3,000.
Gareth Soloway has expressed concerns about the Federal Reserve's ability to cut interest rates as much as anticipated aggressively. Soloway believes an uptick in inflation over the next year could create a challenging scenario where inflation rises even as the economy slows down, forcing long-term rates to remain elevated. This comes as the Federal Reserve recently implemented another quarter-point interest rate cut on Thursday. This follows a larger half-point reduction in September and reflects the central bank's renewed focus on supporting the job market while fighting inflation. Soloway's cautious outlook suggests that the Fed may face headwinds in its efforts to cut rates significantly. The expected rise in inflation could undermine the central bank's ability to provide substantial monetary policy easing, even as the economy shows signs of slowing down. This dynamic, where inflation and economic growth move in opposite directions, could present a complex challenge for policymakers. The Federal Reserve may find it difficult to balance supporting the economy and reining in price pressures, potentially leading to a prolonged period of elevated long-term interest rates.
Just in the cycles that we've seen, we're approaching that 2029 100-year cycle. We've had this unbelievably long period of expansion in the economy due to all this printing of money. The labor market is weakening, albeit slowly. And let's be fair, there's about half the country that has investments. They've handled inflation amazingly well. They see the wealth effect. They're spending money. And then you have the other half that it can't even afford to go to McDonald's anymore, right? I mean, we've seen McDonald's say, hey, people can't afford to come and even eat here. The dollar store is even struggling. I mean, think about that. So my fear is that if the stock market ever stops going up in terms of, let's say, not, making a new all-time high every couple months, then does that then mean that the upper tier slips into recession and then it all comes crashing down? And I mean, that's not even talking about not only the U.S. debt, but the commercial real estate issues. We're now seeing housing start to struggle as well. Interest rates are obviously not coming down very quickly for housing. And so there's a lot of underlying issues with debt, not just in the U.S. deficit, but also in the private markets. I don't think the Fed is going to be able to cut as much as they think they will, because I do think you're going to have that uptick in inflation over the next year or so. And what that's going to do is, again, put the screws to the Fed here, where we start to say, all right, well, now we're in a position where if you have higher inflation, but a slowing economy, which is what I think will happen, is that you're going to have longer term rates stay higher. And that's going to really kill a lot of businesses here. So I don't mean to be a nervous Nelly on the whole thing, but let's take a look at the 10-year yield chart here.
Yes.
And what we can see is we've had this monstrous rally in yields, but look at where it went. Connect a trend line from these highs, connect these lows, and we went what we call right back to the scene of the crime. So yields in the short term, I expect to pull back. But the bigger kicker is this, is if you zoom out, I don't think yields ultimately go below 3.2% or so. And that means that the hope of this free money and easy money policy is not going to go the way people hope it will, where it's back to the great days of post-COVID, where money essentially was free. And it's going to actually take its toll on the overall economy over time, and the housing market, by the way. The housing market's at a lot of risk right now. Stagflation is the worst scenario of all, because people are making less, but inflation is going up, versus during expansionary periods, inflation goes up, people make more. They can generally handle it okay, not great, but okay. So you're going to have a Federal Reserve that is going to see a economy and labor market that is slowly weakening. I think then what you're going to see is the Fed say, okay, we want to lower rates even more. And I still think they're going to lower more times, right? I mean, they're not done lowering rates at this point. But do I think rates are going back to 2% on the 10-year? No way. I do not see that. None of the charts show that. Although I do think short-term rates will pull back here, I just do not see it returning to the good old days when money was essentially free to borrow. And you can honestly blame the government, right? It's the amount of debt that we have out there. It's growing exponentially. The U.S. deficit we now know is just the interest payments are alone the biggest number in the budget on a yearly basis, and that's only going to increase. And you could argue that we need to get those interest rates down because we have to pay this interest on the debt. But remember, we saw the Fed cut 50 basis points and then another 25, and all interest rates did was go straight up. And so it tells you the Fed does not have control, which is a big fallacy, right? Everyone out there thinks that the Fed has control, absolute control of interest rates. They do not. The market ultimately does. The Fed can control it as long as things are normal and calm. But if they lose control of the calmness and the market decides the interest rate.
Gold and silver are poised for long-term growth, supported by economic uncertainty and inflation. Despite short-term fluctuations, gold remains a solid safe haven asset, while silver benefits from rising industrial demand. Both metals offer solid investment opportunities, with silver's price retracements potentially signaling favorable entry points, making them valuable for diversification and long-term capital appreciation. What do you think about the future of gold and silver prices? Share your thoughts in the comments below. If you found this video helpful, make sure to hit the like button, subscribe for more updates, and turn on the notification bell so you never miss out. Thanks for watching, and we'll see you in the next one.